Somewhere right now, a painting worth $40 million is sitting in a climate-controlled warehouse near an airport in Geneva. It's not hanging anywhere. Nobody's looking at it. It's not even really in Switzerland in any meaningful sense, because the warehouse is what's called a free port, a special zone that exists for tax purposes, almost like it's outside the country entirely. The painting isn't there because someone loves art enough to lock it away from the world. It's there because owning it, in that specific building, under that specific legal structure, means its value can grow for decades without triggering many of the taxes that would apply almost anywhere else. It can be bought, sold, and used as collateral for loans, all while ever technically leaving the warehouse, and all while the money attached to it moves in ways that are extraordinarily difficult for any single country's tax authority to fully see. That warehouse is a small, strange example of something much bigger, a global system built over roughly a century that allows an enormous amount of wealth to exist in a kind of legal in-between space, not hidden exactly, just extremely hard to see clearly, and taxed, if at all, at a fraction of what most people pay on their salary. I want to talk about how that system actually works today, because the honest version of the story is stranger, more legal, and more boring than most people expect, and understanding it changes how you think about fairness, complexity, and who actually gets to choose how visible their money is. Here's where most people's mental picture goes sideways. We tend to imagine tax havens as small tropical islands where criminals stash suitcases of cash, something exotic and clearly illegal, happening far away from ordinary financial life. That image isn't entirely wrong, but it's a small, cartoonish slice of something much larger and, in most cases, completely legal. The overwhelming majority of what happens in the world of offshore finance isn't tax evasion, which is illegal, hiding income you're required to report. It's tax avoidance, which is legal, structuring your finances in ways the law explicitly allows, even if the outcome feels like it defeats the purpose of the tax system. That distinction matters enormously because it explains why this entire system can operate so openly, with law firms, accounting firms, and even some governments actively marketing their services for it. You can't advertise a crime, you absolutely can advertise a legal tax strategy, and an enormous, highly sophisticated industry has grown up around doing exactly that. The core insight worth sitting with is this. Tax havens don't primarily work by hiding money somewhere. They work by using differences between countries' laws to create a kind of legal fog, structures so layered and so technically compliant with every individual rule that by the time money moves through them, it's genuinely difficult to say with certainty where it belongs, who owns it, or what should be taxed, and by whom.
Let's walk through the actual machinery, because there are a handful of core tools that show up again and again, and once you understand them individually, the bigger picture starts to make a lot more sense. The first tool is the shell company, a business that exists mostly, sometimes entirely, on paper. It might have a registered address, a name, and legal paperwork, but no employees, no office, no real operations. Shell companies aren't inherently illegal. Legitimate businesses use holding companies for all kinds of ordinary reasons, but they become powerful tools for reducing visible ownership when they're layered, one shell company owning another, which owns another, sometimes across several different countries, each with different disclosure requirements. By the time you're several layers deep, figuring out who actually controls the underlying asset can require serious investigative work, the kind that made the Panama Papers and similar document leaks such significant news events when they happened, because they briefly made visible what's normally designed to stay opaque. The second tool is the trust, a legal structure where technically you no longer own an asset. A trustee holds it according to instructions you set up in advance, often for the benefit of you or your family. Trusts have completely legitimate uses in estate planning for entirely ordinary families. But in the context of tax havens, trusts can be structured so that the original owner maintains significant practical control in benefit, while legally, the ownership question becomes genuinely murky, sometimes murky enough that no single country's tax authority can cleanly claim jurisdiction over it. The fourth tool is transfer pricing, and this one's especially relevant for large multinational companies rather than individuals. When a company has subsidiaries in multiple countries, it can charge those subsidiaries for internal goods, services, or intellectual property use, like the right to use a brand name or a patent. Set those internal prices strategically, and you can shift reported profit toward whichever country has the lowest tax rate, and shift reported costs toward whichever country has the highest one, all through transactions the company is technically having with itself. This is exactly the kind of practice that's led to major, well-publicized disputes between large corporations and tax authorities in multiple countries, precisely because what's a fair internal price turns out to be a much blurrier question than it sounds. And the fourth tool is jurisdiction shopping itself, simply taking advantage of the fact that different countries set dramatically different rules on purpose, specifically to attract exactly this kind of financial activity. Some small countries and territories have built meaningful portions of their entire economy around offering low or zero tax rates, strong financial privacy laws, and fast, friendly company registration processes. It's not an accident or a loophole they stumbled into. For some of these places, it's a deliberate national economic strategy, competing for global capital the same way other countries compete for factories or tourism.
Here's the turning point, and it's the part of this that I think reframes the whole picture. The tax haven system isn't really built on secrecy in the dramatic spy movie sense. It's built on complexity as a kind of moat. Every additional shell company, every additional jurisdiction, every additional layer of trust structure doesn't need to make something literally invisible. It just needs to make the cost of investigating it, in time, money, and legal expertise, higher than most tax authorities and journalists can realistically justify spending on any single case. Complexity itself becomes the product being sold, and it's priced accordingly, which is exactly why this entire industry tends to serve people and companies with enough wealth to make that complexity worth the cost. This connects to something we've circled back to a few times now in this series. Systems built on trust, documentation, and plausibility can be quietly exploited not by breaking the rules, but by using the rules with more sophistication and resources than the system was really built to handle at scale. A tax haven structure isn't lying about anything in the narrow legal sense. It's just extremely, deliberately hard to see through, and seeing through it costs more than most people or institutions have the resources to spend. It's worth being genuinely fair here about the policy debate, because reasonable, well-informed people disagree about it. Some argue this system represents a serious fairness problem, since it allows enormous wealth to be taxed far more lightly than ordinary income, shifting a heavier relative burden on people without access to this kind of structuring. Others argue that tax competition between countries is a legitimate check on any single government's power to tax without limit, and that capital naturally moving toward more favorable conditions is simply how a global economy works. Both of those arguments have real substance behind them, and this video isn't going to settle which one is right. What's genuinely useful is just understanding clearly how the machinery works underneath whichever side of that debate you find more persuasive.
So what's actually useful here for someone watching this who almost certainly doesn't have an offshore trust structure of their own? The most direct thing is understanding that the underlying principle, legally structuring your finances to reduce your tax burden, isn't exclusive to billionaires, even though the scale absolutely is. Retirement accounts, health savings accounts, certain education savings vehicles, these are, in their own much smaller and much more heavily regulated way, examples of the same basic idea. the law explicitly creating structures that let you reduce your taxable footprint on purpose as a matter of public policy rather than a loophole. Understanding that distinction between legal structuring the law intends and available to ordinary people versus what wealth and legal sophistication can access at a much larger scale is genuinely useful for making sense of your own financial planning without feeling like the whole tax system is stacked entirely against you. It's also worth understanding this system when you're evaluating news about it, since headlines about offshore leaks or corporate tax disputes can be confusing without the basic framework. Knowing the difference between evasion and avoidance, and knowing that shell companies, trusts, and transfer pricing are the recurring tools involved, makes it much easier to read those stories with real understanding instead of just general outrage or general confusion. And more broadly, this is a genuinely good example of a pattern worth carrying into other parts of financial life. Complexity is not automatically suspicious, but it's also not automatically neutral. When something is deliberately, expensively complicated, it's worth asking who benefits from that complexity existing and who's being kept out by the cost of understanding it. That question applies just as well to a mortgage document, an investment product, or a subscription's terms of service as it does to an offshore trust structure. Complexity, wherever it shows up, is doing work. It's worth asking what that work is.
What stays with me most about this particular system is how thoroughly legal most of it actually is. There's no dramatic villain twirling a mustache in a tax haven. There are law firms, accountants, and entirely legitimate government policies, all operating within rules that were, in most cases, written and passed by actual legislatures. The system isn't hiding from the law. In a very real sense, it's made almost entirely out of it. That's a strange thing to sit with, because it means the usual instinct that something wrong must involve someone breaking a rule doesn't quite capture what's happening here. Sometimes the more interesting and more important question isn't whether a rule was broken, it's who got to write the rule in the first place and who had the resources to make full use of it once it existed. You don't need an offshore account to benefit from understanding this. You just need to remember that a system doesn't have to be secret to be genuinely hard to see clearly. Sometimes it just has to be complicated enough that most people reasonably give up trying to look. Seeing the shape of it anyway, even imperfectly, even from the outside, is worth something on its own. Progress beats perfection here, too. You don't need to understand every layer of global finance. You just need to know the outline well enough that the next headline about it makes a little more sense than the last one did.
If understanding how these systems actually work is useful to you, that's really the purpose of this channel. I'm Business Decoded, and if you want more of this kind of analysis, subscribing helps. Thanks for watching, and I'll see you in the next one.